Thanks for tuning into this audio summary of our June 2026 Assured Briefing. I'm Bill Wilt of Assured Research, and I'll summarize the main points for you. Our first note is an update to the outlooks and perspectives that we've expressed over the last 6 to 8 months or so, looking out over the balance of 2026 and 2027. We're less worried about being right in any of these prognostications and more hopeful that our perspectives can help companies think about their own markets and what could transpire. So here's the list of items we discuss. First, we see signs that social inflation may be moderating. That doesn't mean liability costs aren't extraordinarily high. We're simply observing that the rate of change appears to be slowing. We expect capital management to accelerate in the second half of 2026 and 2027 as a cycle management tool. We had thought by now that we would see rising deal volume in the insurance space, but that simply hasn't transpired. The macro environment is ripe for it, so we'll have to wait and see if any large deals are done. We think the upcoming year, 2026 and into 27, will add support for the adage that the earnings cycle follows the pricing cycle. We remain more bearish on the economy and more hawkish on inflation than what we pick up from reports by economists or investment banks and even market data. We see pressures on commercial auto as lessening and largely expect that loss ratio to gradually improve in 2026, although we'll note that a recent Supreme Court decision establishing liability for freight brokers could represent more than just a bump in the road. If trial attorneys use that ruling as an opportunity to expand the entire size of the commercial auto litigation pie, that could be a problem. We expect price competition in personal auto to accelerate, perhaps even more than consensus expectations. The recently reported first quarter 2026 accident year or accident quarter loss ratio was 2 standard deviations below the century to date average. Let's move on to our second note, where we explore the primary means by which private capital can invest in law firms, and that's through management service organizations. Now, it may be hard for lawmakers to stop that process, and insurers hoping to blunt that trend should probably be careful what they wish for, because it's a model that's used frequently in the insurance world. In our next note, we answered 2 questions posed to us following release of our Assured report on tornadoes released in early May. First, the answer is yes. Tornadoes and hail events are mostly correlated. Interestingly, that's true for most months out of the year, with a strong exception being July, August, and September, where their correlation falls off. We understand there are various meteorological reasons for that. But a second question posed was asking if tornadoes are moving south and east, are hailstorms also moving in the same direction? The answer from our work is an emphatic no. Now, the next note provides an update on federal and private flood insurance sold over the past decade. The bottom line is that premium growth is really pretty slow, and that the number of participants in the private program, corporations participating in the private program, has actually fallen off over the last couple of years. But with the peril of flood rising and the new efforts by the federal administration to encourage private participation, we think the market will grow in the years ahead. In our next note, we look at the performance of banks and property casualty insurers in a financial analysis note viewed through the lens of capital regulation. The bottom line is that banks are on the upswing, with bank regulation acting as a headwind that's diminishing, i.e. it's improving, and that's helping the banks grow their business. We have a new style of note focused on enterprise risk management, where we turned our 50-year industry model across 7 major lines of business into a live analytical tool. The note includes takeaway bullets and lots of pictures, so you don't have to get into the details to understand it, or hopefully to get something out of it. The 2 main takeaways would be that first, in a typical and normal stress scenario, call it a 1 in 4 year bad year type of year, that's most typically characterized by underperformance across all lines of business at the same time. But when we move to the 1 in 10 or 1 in 20 stress scenarios, the 90 or 95th kind of percentile. Those usually involve underperformance in commercial liability at the same time as really high combined ratios in the property lines as from a major catastrophe. So think adverse development hitting at the same time that it's a bad cat year. That's probably all intuitive, but the value here is that the model is trained on the industry's actual results over slightly more than 50 years, and we give you some specific metrics to consider, and you can see the performance of the different lines. So we hope you find that interesting. Winding up here, I'll point out that our trend spotting section includes just a few slides from an assured report that we've published for the last few years, which analyzes the industry's expense ratios in detail by line of business. Anyone interested in the full PowerPoint is welcome to ask for it. We suspect that has been and can be useful for benchmarking purposes. And before concluding, I just wanted to share that we've been making use of an assured research agent trained on our publications over the last few years for some time now. It's a really helpful tool for us as we reflect back on research we've published, answer your questions, and consider past conclusions. But the point is that we have a process now by which subscribers can create their own assured research agent. We've made passing the knowledge documents easy so that to help facilitate creation of the agent. And if you're interested, just reach out. We'd be happy to talk with you about it. So that concludes this summary of the June briefing. We hope you're encouraged to read or skim the document at least. And please remember to reach out with your questions, comments, or research ideas. Hope you have a great rest of your day.